Depending on who you listen to right now, the economy is either achieving a miraculous soft landing or preparing for a standard correction. But if you set aside the cable news talking points and look at the raw mathematics, the kind of math that doesn't care about political parties or central bank promises, we aren't heading for a correction. We are heading for a termination point. Most people are glued to the daily stock prices or the monthly inflation reports, thinking those are the signals that matter. They aren't signals. They are merely symptoms of a much deeper pathology. The real signal is a timeline that has repeated with terrifying accuracy for the last 300 years of Anglo-American history. It is a cycle that governs the rise and fall of empires, and it operates on a clock that is almost exactly 80 years long. The last time this cycle peaked was World War II and the Great Depression in the early 1940s. The time before that was the American Civil War in the 1860s, and the time before that was the climax of the American Revolution in the 1780s. We are now 6 years into the fourth iteration of this cycle. According to the data, the climax, the moment the debt burden becomes mathematically impossible to sustain, aligns perfectly with the year 2026. In this presentation, I'm going to walk you through the 80-year debt supercycle. I'm going to show you the 3 phases we've already passed and the dangerous 4th phase we are entering right now. I will demonstrate why 2026 isn't just a guess, but a mathematical certainty derived from bond market mechanics and historical precedent. And most importantly, I'm going to explain why this next crash won't look like 1929. It will be far worse because this time, the money itself is the problem. To understand why the financial system is breaking, you first have to understand the concept of time. Historians William Strauss and Neil Howe coined a term called the fourth turning. The concept is simple but profound. History moves in cycles of roughly 80 years, which is the length of a long human life. Why 80 years? Because that is exactly how long it takes for a society to forget the painful lessons of the past. The generation that survives a crisis, like the Great Depression, builds rock-solid institutions to prevent it from happening again. They are prudent, they save money, they fear debt, and they value stability above all else. But their grandchildren? They didn't see the pain, they only saw the resulting prosperity. They take stability for granted, they leverage the system, and they borrow against the future. Eventually, the debt becomes so large that it crushes the very institutions their grandparents built. Let's look at the dates, because the rhythm is undeniable. 1781 was the climax of the American Revolution, a total systemic reset of the colonies. Add 80 years to that date, and you arrive at 1861. That was the American Civil War, where the currency collapsed and the nation tore itself apart. Add another 80 years, and you land on 1941. That was the height of World War II and the tail end of the Great Depression, a complete restructuring of the global order. Now, add 80 years to 1941. Where does that land us? It lands us squarely on 2021. Think about what began in that window: a global pandemic, supply chain collapse, the return of inflation, and the outbreak of kinetic wars. We entered the crisis window right on schedule. But the climax, the moment the old financial order actually dies, usually happens 5 to 7 years into the turning. That puts the target directly on 2026. This isn't astrology. This is behavioral economics and the cycle of debt accumulation. Right now, we are at the very end of the winter phase. If you want to survive the winter, you need to understand the weather patterns. While the fourth turning explains the social timeline, the economic mechanism is what we call the long-term debt cycle. This is a concept popularized by Ray Dalio, and it explains exactly why our current prosperity is an illusion. For the last 40 years, since the early 1980s, we have been in a massive bull run for bonds. Interest rates went down and asset prices went up. Every time the economy stumbled, the Federal Reserve lowered interest rates and printed money to smooth it over. This encouraged everyone, governments, corporations, and individuals, to take on more debt. Think of debt like a drug. In the beginning, a little bit gives you a burst of energy. You can buy a house, build a factory, or wage a war. But eventually, you need more debt just to keep the system functioning at a baseline level. You aren't taking the drug to get high anymore. You're taking it to avoid withdrawal. In 2022, we hit the wall. Inflation forced the Federal Reserve to raise rates, and suddenly, the cost of servicing all that debt exploded. We have reached the end of the long-term debt cycle. This is the moment where the central bank is trapped. If they keep rates high to fight inflation, the debt collapses the economy. If they lower rates to save the debt, the currency collapses. This is the setup for 2026. The debt load is so high, over $35 trillion for the US government alone, that the math no longer works. We are mathematically insolvent. Historically, when a nation reaches this point, there's only one way out: default. But the United States cannot default explicitly without destroying the world economy. So they will default implicitly through inflation. When people hear financial crash, they instinctively think of 1929. They think of the Great Depression, stocks falling 90%, deflation, and prices dropping. They imagine a world where cash becomes king. If you are holding cash right now waiting for a 1929-style crash so you can buy cheap assets, you are making a fatal mistake. 1929 was a crisis of liquidity. There wasn't enough money in the system because the gold standard constricted the money supply. So when the bubble burst, prices fell. 2026 will be a crisis of solvency. There is too much debt, and the only way to pay it is to print more money. We are not looking at a deflationary depression like the 1930s. We are looking at an inflationary depression like the 1940s. Or perhaps even worse, a currency crisis like Weimar Germany. In 1929, the dollar gained value. In 2026, the dollar is the victim. Imagine a world where the stock market goes up. The Dow hits 50,000, maybe 60,000. But in that same world, you can afford less food than you could when the Dow was at 30,000. That is the crack-up boom. That is the stagflationary hell we are walking into. The numbers on your screen go up, but your standard of living crashes. That is why this cycle is more dangerous than the Great Depression. In the Depression, if you had money, you lived like a king because things were cheap. In this next crisis, having money won't be enough. You'll need the right kind of money. If you remember only one thing from this presentation, remember this next fact. This is the smoking gun, the mathematical proof that the system is in the end game. For the first time in history, the United States government is spending more money to pay interest on its past debt than it spends on its national defense. Let that sink in for a moment. The greatest military superpower in history is now paying more to bondholders than to its soldiers. This creates a death spiral. To pay the interest, the government has to borrow more. Borrowing more increases the debt. Increasing the debt increases the interest payments, which requires more borrowing. It is a mathematically exponential loop. There is no way to grow your way out of this. There's no way to tax your way out of this. If you taxed every billionaire in America at 100%, it wouldn't even fund the government for 6 months. This is why 2026 is the target. Based on the current trajectory of interest rates and debt issuance, by 2026, interest payments on the debt will likely become the single largest item in the federal budget. It will surpass Social Security and Medicare. When that happens, the bond market breaks. Investors will realize the U.S. government literally cannot pay them back in real terms. They will stop buying Treasury bonds. And when nobody buys the bonds, who's the only buyer left? The Federal Reserve. They will have to print trillions of dollars to buy the government's debt just to keep the lights on. That is the moment the dollar dies. That is the event horizon. We are already seeing the cracks in the dam. In late 2023 and throughout 2024, we saw weak auctions for U.S. Treasuries. That's technical speak for nobody wanted to lend money to Uncle Sam at the current rates. The bond vigilantes are waking up. These are the institutional investors who control the global debt markets. They are demanding higher interest rates to compensate for the risk of holding U.S. dollars. But remember the trap. The government cannot afford higher rates. So what happens in 2026? A massive wall of short-term government debt matures and needs to be refinanced. Trillions of dollars of debt issued during the pandemic at near 0% interest will roll over. It has to be refinanced at 4%, 5%, maybe 6%. This will likely trigger a liquidity freeze in the Treasury market. The plumbing of the global financial system will clog. The Fed will have no choice but to implement yield curve control, just like Japan has done and just like the US did in the 1940s. They will peg interest rates artificially low and print money to cover the difference. This saves the government, but it sacrifices the currency. This is the moment hyperinflation moves from a possibility to a probability. Ask yourself, if you knew the government was going to print $10 trillion in a single year to save the bond market, would you hold dollars, or would you buy anything that isn't nailed down? And unlike the 1940s, the United States does not have this playing field to itself. We have sharks circling in the water. The BRICS alliance, Brazil, Russia, India, China, South Africa, knows exactly what is happening to the U.S. debt cycle. They are reading the same balance sheets we are. Why do you think central banks around the world have been buying gold at a record pace since 2022? They are preparing for the U.S. default. They are preparing for the moment the dollar loses its status as the singular reserve currency. When the U.S. prints trillions in 2026 to save its bond market, these countries will dump their dollars. Those dollars will flood back home to America, causing domestic inflation to spiral even faster. It is a perfect storm. First, the 80-year cycle demanding a reset. Second, the debt trap making solvency impossible. Third, the geopolitical rivals waiting to strike. All of these forces are converging on the same window, 2025 to 2027. I know this sounds terrifying. Worse than the Great Depression is a heavy claim to make. But I'm not telling you this to scare you. I'm telling you this because there's a massive difference between the end of the world and the end of an era. The world isn't ending, But the era of easy money, cheap debt, and American unipolar dominance is ending. In every 80-year reset, wealth isn't destroyed, it is transferred. It transfers from the creditors to the debtors. It transfers from those holding paper promises to those holding real assets. In the 1930s, the people who owned gold and productive land survived and thrived. In the 1970s, which was a smaller mid-cycle crisis, those who owned commodities made fortunes, while stock investors lost a decade of returns. 2026 is coming. The math is written in stone, but your financial fate isn't. You have a choice. You can stay in the default world of stocks and bonds, hoping the 80-year cycle is wrong for the first time in history. Or you can position yourself for the reset. The question you need to answer is simple. How exactly do you position for a solvency crisis? What creates the anti-fragile portfolio? I've broken down the exact asset allocation strategy for the 2026 transition in the video linked right here. I dive deep into the specific ratios of gold, energy, and foreign equities that historically survive these resets. Do not wait until the bond market freezes. Click this video now. I'll see you there.